So now we come to the interesting bit of this morning. The guidance is in, the stock market has reacted, and now the protagonists are here to tell us why they set out the guidance that they did for fiscal year 2010. S. Gopalkrishnan, S. D. Shibulal, and V. Balakrishnan, as always, to start off the Infosys Boardroom. Gentlemen, morning. Thanks for joining in. Chris, take us through the guidance first. Why you guided a 3 to 7% roughly a degrowth in revenue in dollar terms for next year?
See, the environment continues to be challenging. Most of our clients are seeing challenging environment impacting their own revenues, their own performance. And currency markets seem to be quite volatile. There's a lot of uncertainty. And when we did a survey of our customers, they're also telling us that their IT budgets are going to be down. So based on all that and the visibility we have, we gave a guidance, which is, if you look at constant currency terms, it's about, flat to minus 2.5%.
Shibu, what's the problem in laying out the guidance? Was it that you are or is it that you're expecting a lot of pricing decline in fiscal 2010, or is it that new business is getting tough to come by and therefore you are factoring in quite a bit of volume degrowth?
So, as we have said in the past, our guidance is a statement of fact, as we see it today. So we are looking at the next 1 year, next quarter, and giving you a guidance based on all the facts which we know. And so we have to consider all those facts. Recently, we have done a survey of our clients. We have done a survey of our clients through our engagement managers, our master client owners. And 61% only has closed their budgets. 89% has said that there is downtick in their IT budgets. So we are considering all these factors. While 89% said that there is a downturn in their budgets, 22% said that the offshore spend will remain flat, and 5% said that the offshore spend will go up. So we have to consider all these factors, and we have considered all of those while giving you the guidance.
Bala, quick word on margins. They have slipped in Q4, but what are you factoring in giving out the Q4 guidance? How much of a slippage in margins?
Well, if you look at the next year's guidance, we are assuming the first quarter the revenues could decline, and for the full year the revenues could decline on a constant currency basis of something around 4% in the lower end of the band and almost flat in the upper end of the band. We assume that the operating margins could come down by around 300 basis points because one, pricing, we take the fourth quarter pricing to remain constant for the next full year, which means an average drop in pricing between fiscal 09 and fiscal 2010 by around 6.5%. Of course, it could get offset to some extent because of the rupee, but overall, the operating margins could impact by around 300 basis points. At the net level, it could impact by around 200 basis points. Normally, when you give a guidance, we always said operating margin could be within a band of 50 to 100 basis points. In this challenging environment, that has gone to 300 basis points.
Chris, I just want to scratch the point about the guidance that you've put out this time, because for FY09, you've missed the full year guidance that you had started off with. You also worked with the back-ended theory, which didn't work out for that fiscal year. What is it that you are factoring in for FY10? Do you expect this one to be a back-ended year of growth? Because your Q1 EPS growth shows quite a sharp dip.
Yes, as Bala said, we have assumed a decline in the first quarter and then, almost flat for the remainder of the year. With slight growth or flat for the remainder of the year. Now, we did revise our guidance for FY09 in the end of second quarter and into the third quarter. And you have to remember that, the world before September 15 and the world after September 15 was very, very different. We had one of the best second quarters ever, in the recent times with significant sequential growth. So coming off that, we said that we have to revise the guidance down. So we immediately reacted, we saw what was happening, and we had to change the guidance. But, even this quarter, if you look at it, the revised guidance we met at the bottom, of course. What is it going to be this year? We have given you the position from today, right, from what we know today. It is a challenging environment, but we felt that it is important for the company to share the data we have with everyone, and that is what we have done at this point. When we give a guidance, we work very hard to meet that, and And by and large, of course, we've done that. It's just that if the environment is quite volatile, the fluctuations in currency, the changes that are happening are unprecedented in some sense. And that is the challenge we are faced with.
Shibu, what is the ground reality in terms of budget spends? Is it the documented 10 to 15% cut that you've seen in budgets for your clients, or is it that these budget allocations as well or trends are becoming irrelevant because we understand there's now monthly allocations that some clients tend to give out to their vendors?
So if you look at our top 135 clients where the budgets are closed only in about 60 to 70%, 89% said that it's down, and out of that 89%, 69% the budgets are down more than 10%. So it's considerable down, and that is the data which see. What is important for us is our client base, right? And we are looking at the top 135 clients who is contributing something like 83% of the revenue for us. The second important point is to note that even when the budgets are closed, they are not etched in stone this year. It could go up or down based on the economic conditions. So as the year unfolds, if the economic conditions go up or down, the budget will go up and down. And that is what we are seeing.
Bala spoke about a 6 to 6.5% decline in pricing. Can you just take us through what your assumptions are on on-site and offshore pricing, and whether this is spread across verticals or whether it's only specific verticals are giving you this kind of a pricing pain? Shivu. Whoever.
No, look, what we are saying is, in the third quarter, on a constant currency basis, the blended pricing, the overall basket, came down by around 1.5%. In the fourth quarter, that is March quarter, it came down by around 2%. When you assume the fourth quarter pricing to remain constant for next full year and take on an average to average basis, because pricing is unknown, we believe the environment to some extent has stabilized. But if there is some catastrophe happening in the environment, probably it could become challenging. Right now, what we know is what the pricing we get today. We assume that to continue for next year. And if you assume that, on an average basis, the pricing could decline by around 6.5%. That is what we assumed in the guidance. It is on the overall basket basis. It is not client specific. So when we approach pricing, our approach is always on a overall basket basis, not on client to client basis.
Sure. What can you do to mitigate this pressure that is coming into margins from the pricing front? What kind of levers will you use, and do you see yourself cutting costs very, very much more significantly in FY10 than you did in FY09 already?
No, look, Brian, look at it this way. The currency has gone to 39.5. The currency has gone to 50.7. If you look at our margins, it's almost same. So you have seen a volatility of 30% in currency, and it has not impacted your margin. We always say we have multiple levers on the cost side, whether it's utilization or on-site offshore mix or pricing or scale benefits. So we have to pull some of the levers at some point of time and manage that in an extraordinary volatile environment where not only rupee, if you look at GBP or euro, all of them moved by 25-30% year on year, and we managed it well. So I think we have a flexible cost structure which allows us to quickly turn around and make sure the impact on margin is minimized. I think we have a great model now.
Uday, let me also add, our plan is to change those conversations to a value-based conversation, right? So we will convert those conversations in 3 or 4 different ways. One is that we will convert the conversation into a new engagement model where we will offer pricing in a different manner. It will be based on transactions. So by doing that, we will reduce the total cost of ownership while we maintain our margins and our benefits. Another way of doing it would be to link it to volume, link it to a time period, or give a discount for a certain period of time so that they are over the pain. So we will give a discount for 1 year. While we are doing all this, as Bala said, we had a 1.4% reduction last quarter and 2% reduction this quarter, which is not really that drastic. We still get a premium over our competition even today because clients do understand the value which we provide.